but I am now joined by Lawrence Yoon, the Chief Economist for the National Association of Realtors. We've been talking a lot about high mortgage rate. It seems to be the only thing we're all talking about today, but it's really frozen the inventory across the country as sellers kind of want to hold on to their rates. Are we seeing things begin to thaw as we're seeing a little lowering of those rates?
Well, certainly I do expect the mortgage rates to steadily decline. I mean, it did decline this week according to Freddie Mac, lightly, but I think there's further decline, but it's not going to be in any major way. I think the low point for new normal to be about 6%. Today is closer to 7%. And regarding the inventory, what we are beginning to see is that despite the lock-in effect incentives, we are beginning to see increase in inventory, about 20% higher because of life-changing circumstances that many households are encountering.
And so you mentioned that we'll eventually see those rates head to 6%. We want things to happen quick here, right? Where the New York Stock seems like do things quick, but where do you see those rates by the end of the year, and how much of that movement do you see will really take into 2025, 2026 to get down to that 6%?
The Federal Reserve is likely to cut interest rate maybe 1 or 2 times this year, but I think there's another 4 rounds of rate cut next year. So we are looking at downward cycle in terms of interest rate cuts. So that will bring down the mortgage rate. However, it's not going to go down to 3%, 4%, or even 5%. We have a massive federal budget deficit we need to think about. So when the government borrows, there's less money available on the mortgage market to lend it out. So mortgage rate will be lower, but don't expect super low interest rates.
Yeah, so you said 6% is that new normal. The thing about normal though, whether it's normal or not, it's what does the market think? How long do you think it'll take for those sellers who are sitting on their 3% mortgages to say, you know what? 6% is the best I'm going to do, it's time to sell.
People have growing families, they need a larger house, or maybe some empty nesters or retirees who want to trade down. So we will begin to see more inventory coming onto the market. Good thing that the builders have been ramping up production, so we are also getting that new home inventory on the market. So that will make the market more smooth. Right now the market has been frozen due to the lack of inventory, and of course that was due to the high interest rate, but as the interest rate begins to go down, it's going to thaw the market, as you said, Pete. So that will lead to more transactions, more people able to become homeowners, and maybe it tames the price growth, because we cannot have home prices keep rising above people's income growth.
Yeah, definitely, and our viewers at home are seeing UWM making their way through the halls. UWM recently announced a plan to basically do 0% down using a lien loan on the home. You think of those first-time home buyers, the price to get in, both needing a down payment. Now we're looking at higher interest rates. What are you seeing in the data that suggests, should those first-time home buyers be looking at that traditional 30-year mortgage, or as you keep saying, the rates are going to go down, should they look at those 5- and 7-year mortgages and hope to refinance at a future date?
So for some people who expect a rising income, say people who are graduating from medical school who expect a much higher income in the future, I think adjustable rate mortgage makes perfect sense, especially knowing that greater likelihood of a lower interest rate in the future. But I think for the most people, they like that fixed rate, the assurance of fixed payment not rising or not changing at all for the next few years. So I think but the 30-year fixed rate will still be the more popular over the adjustable.
So more popular, but is it the right way to go?
I think, for some people it certainly makes more sense on the adjustable rate mortgage. If we remember one of the testimony by Alan Greenspan when he was the Fed chairman, he thought that most people should be getting the adjustable rate mortgage because people do not stay in their home for 30 years. They stay in their home for 7 years. So get that 7-year adjustable fixed payment for 7 years, and once it's time to move, well, the mortgage rate change does not really matter.
Right, and so our viewers at home are seeing that the UWM team has entered the trading floor, which means our time is starting to run out. But we have a few more minutes. So when we're looking at the overall economy, the overall housing market, what else should buyers and sellers be looking at? Is it just that interest rate? Are there other things they should be looking at?
The inventory condition, because what we are finding is even though home sales are low, it is low due to lack of inventory. Multiple offers are still happening on 1/3 of the property, implying that not all demand is getting satisfied in the market. So as the interest rate goes down, more inventory shows up. Well, that's going to make a market, more buyers and more sellers.
So more buyers, more sellers. That's what we like here at the New York Stock Exchange. We really like more buyers and sellers coming together. You know, it was interesting. We were talking to Ravi Kantha, who's selling. He was talking about how the connectivity between how people look at interest rates on mortgages and the stock market. And obviously, there's also a lot of connectivity between the two. You know, obviously you have your specialty in real estate, but how are you viewing what's happening in the market compared to what's happening with interest rates in mortgages?
You know, the stock market has been near all-time high, so that has led to all cash transaction being a little higher than previously. Right now, it's about 1/3 of the market. It used to be about 20% pre-COVID condition. So certainly, rise in stock market is helping in some of the cash transactions, but nonetheless, we know the relationship. When interest rate decline, generally the stock market tends to go upwards. So you know there is a linkage there, but naturally, most first-time buyers need to take out a mortgage, and it is critical to have some low down payment products or even zero down payment product, as long as they can demonstrate the ability to repay the mortgage.
That's always very important, and that's where the data takes us. And mentioning the low down payments, UWM with their one of their programs, one of the largest doing that in the business. Our reviewers are seeing us now. They're now on the trading floor of the New York Stock Exchange. They're signing the Distinguished Guest book. That was the same book that Matt Ishbia signed when the company went public, and now our first-time bell ringer will be signing that as well.
Well, great. It's a great day to see more competition in the marketplace, more mortgage flow into the market. So great thing about American capitalism that the New York Stock Exchange is able to offer.
I could not have said it better myself. Thank you so much, Lawrence, for joining us today, and I hope you come back soon.
Thank you.